Good turnaround Tuesday, Warriors. How's everyone doing? Good. Something did manifest that I was talking about for last few weeks. 10-year yields, new lows. There you go. And in a big way. In such a big way, it's not blowing out the daily divergence, but I don't see any. 4 hours trying to hold. God, it's so close I could taste it, guys. Everyone hear me okay? Good morning, Craig, Claudia, Tom. Everyone doing okay?
Loud and clear, Coach.
Oh, hey, Steve. Great to have you back. So I'm not sure what news sparked it, but, I was short the yen based upon the correlation. And, something I have to say, I took them in because really the yen's acting pretty tough if you just look at the yield picture. I don't know. I was waiting for longs down here. I figured while I was waiting for longs, I thought, yield looked so weak that I thought we'd be here by now, 107.60. So in front of the Fed, remember we have the Fed, everyone. I'm doing some book squaring today. My timing was terrible in euro pound. Started probing that and scaled in yesterday, and I'm still in it, but I really don't like it because except for the 4 hour, 4 hour almost confirmed, but the divergences on EG was completely blown out. So I don't know. See this? So even if the market's starting to come back to me and I see something like this, it makes me nervous, and I'm more in the mood for looking for an out, and I don't care about profit or loss. I missed it because I was sleeping. I would have done something here. I may still do it. Anyway, that, a little heat there. But something I was talking about that also happened was Aussie Kiwi. So Aussie Kiwi was holding the 50% retrace here, and it still is, but I was talking about it up here. And to me, it looks like good possibility of it giving up the 50% retrace. And if that happens, and this is a counter trend, I think Steve and Greg would say this is corrective after an impulsive move, but working off this huge overbought condition by moving sideways. But looks like 60 halfway will give out. I may look at it here at 61.8 because I respect the way it's given it up. Tried to turn good off 50%. Maybe one more flush to 61.8. That's on my watch list down here now. Covered shorts there too. And gold looks destined for another high. Yeah, here we go. So talked about this yesterday with Blake. I thought we'd make a move towards another high. The whole world's waiting for the breakout. You know what? My feeling of what may happen in gold is confirmed by one of my teammates yesterday, Greg, okay? And someone else I interviewed, I think it was Will Patton, and he's with Avi, and he showed a chart when I interviewed him, and he's coming up here pretty soon. And this was, I don't know, a few months ago. But he showed a chart that we get the breakout over 1380. And I think Greg showed it going to maybe 1400 after that. I don't know, maybe 1420. I mean, people are going to be talking 1600 on this because, classically, that's what it measures. You just take this whole range, you could take it all the way from 1050, $300, tack that onto the breakout. You're talking 1600. That's what a lot of people are going to be talking about here, at least 15. Oh, here, 1419 is 1.27. Okay. Anyway, so that's what Grega thinks is going to happen. Not that there's not good money, from here up to there. Look, it's doing nothing wrong on the weekly. It's holding. Anyway, is there any news like the Fed already cut rates the way yields are acting today? You guys know what a fundamentalist I am, right? So I have no idea what sparked the big drop in yields because it doesn't look like it's risk off to me, guys. S&Ps are challenging last week's highs, and I don't know what to do with it. It looks like it wants to make a new high. So get it over with. Maybe we're going to just rally into the Fed meeting into July. Some of my intelligence gathering and a guy who's very good with Gann stuff that also was interviewed here a few times, Zextra Dax, has like July 16th or 18th for the most important turning point of the year. So if the market's going up and we're at 3,000, 30.25, a lot of targets people have, that may be the play, the inflection point there. Anyway, flat yen, although I still think it has a chance to break back down towards here. And I respect the way the yen's acting because with what yields did, it should already be down here. So maybe yields keep dropping. But I'll just out of principle, I'm going to have to try longs down here. Okay. So who's here today that's not a member? Anyone? Trump tweeted a Draghi hate message. Okay. Why is he mad at Draghi?
The usual nonsensical stuff.
You mean because the dollar's too strong against the euro and hurting our trade?
He's mad at Draghi because in his mind, Draghi is, propping the dollar by talking down the euro, which at that point, it makes 100% sense if it was coming from the same person that at the same time claims that the US has the best economy ever, but the Fed should be at 0% rates and doing QE.
So, Steve, how does how do things look from overseas when you foreigners look at America now?
What do you mean?
I mean, not just your opinion. You talk to a lot of people.
From an economic perspective, the vast majority of people don't have the ability to. They don't understand economics. So this is purely a comment that has to do with the hypocrisy. The vast majority of players here, and when I say players, I include politicians and monetary policy heads. They're all hypocritical. As basic examples, you will never hear central banks saying we're afraid that the recession is coming because they think that that's going to spark a recession faster or make it bigger. So by default they can't be honest about it. So in the same way they can never be honest about what they're doing or what their actual intentions are. At the same time, but there's a limit. Usually politicians try somewhat to stay out of it. Trump at the same time wants to claim that the US has the economy ever and that it needs the most monetary stimulus ever. Now, those two things don't add up.
That's not what sparked the drop in yields today. What did, Steve?
In general, we see that there are jitters out there about what's happening with the fundamentals now.
Okay, so no, there wasn't a catalyst. It's just there's no news behind it, is what you're saying. I can explain why it's happening.
No real news for the U.S. yields. For the bonds to be bid, there are news. Draghi, in essence, pointed to more stimulus that the European Central Bank is preparing to add more stimulus, and as you understand, that obviously puts a bit under the bund. Now, on one sense, because the two benchmark bonds, I mean the treasuries and the bonds, are very highly correlated.
Yeah,
I'm pretty sure that has had an effect as well.
Yeah, that's it then.
In parts, definitely yes.
Yeah. Okay. Is Blake with us today?
I'm guessing.
Okay.
Blake,
right here.
How are you,
Hey.
buddy?
Hey, good morning, guys.
Yeah. What's happening here, Blake? Turn around.
Just I guess what I'll do is I'll take over the charts here, but we were talking about you were talking about what happened to the euro and yields and everything else.
Yield.
The euro dollar came off when Draghi overnight basically said that he's looking that the eurozone needs more stimulus, and then so the euro actually slumped to these lows a few hours back, and then we spiked up because Trump tweeted basically it's unfair how the ECB how Draghi can weaken his currency with more stimulus. It's basically he was just making the argument that it's just not fair that ECB could do that. And then right after that, ECB a headline came out that the ECB officials see rate cut as their primary tool to stimulate the economy. Then the euro came back down. So basically, it's Trump is trying to his hardest to engineer a weak currency, but the ECB is doing a pretty good job at it this morning themselves ahead of the FOMC meeting tomorrow. So, and frankly, I don't know if the Fed is going to play ball with Trump's idea. As Trump wants a rate cut probably more than anything.
It makes me think, Blake, that if it continues and the dollar continues to get stronger and goes to some of those bulls objectives, that it would not be beyond President Trump to have his Treasury Secretary Mnuchin begin to intervene to weaken the dollar instead of trying to jawbone it. I think that's what it's probably going to take, and I think they would. Eventually, they're going to do that.
Yeah. I mean, that's potentially that could be the case, or maybe Mnuchin might actually start with some rhetoric where he typically will not as Treasury Secretary. So we'll see, and we'll see what happens tomorrow.
He never talks about the dollar.
No, but the Fed is expected to keep rates unchanged tomorrow. Very few feel that they're going to actually cut tomorrow, but they're going to pave the way for future rate cuts. So the question is, how dovish is the Fed going to be tomorrow? And
wow, what if he's hawkish tomorrow? No
it could be. I mean, it's how do you be dovish when the U.S. economy and the economic data that we're getting, generally speaking, is still pretty strong. I know the employment numbers are starting to level off a bit, but we all know that we're at full employment. So, but if you look at all the other data that's out there, the U.S. economy is still chugging along nicely. So it's
even retail sales Friday was pretty good, Blake.
Yeah, it's good, and you look at the PMIs; they're not bad, and so that's why the argument is, how can the Fed be too dovish tomorrow? And now obviously,
S&P's a new high. New recovery highs pressing them here. Why would they use any ammo?
Yeah, so we'll see what happens, but I'll tell you a few things that are jumping out at me today about these moves. First and foremost, let's talk about gold. As you mentioned a little bit earlier, gold is strong, and gold's strong, and we're heading back towards that really key resistance around that 1360 level. We're getting close once again. It's hard to chase gold up here, obviously ahead of the FOMC, but it looks extremely strong. It looks like we could quite possibly break out this week. one of the thought processes here is gold is extremely strong because all central banks are looking to lower rates or continue to stimulate growth via interest rate policy, which in turn will stoke inflation. I guess that the thought process would be. So you've got gold that's getting ready to probe that really key resistance once again at that 1365 low. Excuse me. Sorry. And as you can see here, that this is going to be a big breakout in the event that we break out and gold could really start to squeeze higher. But you've got gold on the move. You've got silver's hanging around near that 15 level, and it'll be interesting to see if silver breaks 1510. We can see that outperformance of silver maybe over gold, which would, as we've talked about here, Dale, that we could see that the confirmed move in precious metals. So that's something that I'm obviously looking at. The other thing that it obviously stands out today is take a look at the bond market and take a look at boons. Boons are at all-time highs, and one of the drivers why the euro is weaker, or maybe vice versa, is one of the reasons why bonds are so strong, is that the euro is so weak. But we have completed this is a measured move of this triangle. So here, let's delete that, and you can see boons have basically completed that move, and then we have 161% extension, which we're overshooting right now, obviously. But if boons start to at least consolidate or maybe even pull back here a little bit, that might be the juice that gooses the euro higher from current levels, especially ahead of the FOMC. I would be pretty. It's hard to get too bearish the euro or bullish the dollar ahead of the FOMC. And especially if you look at some of these other dollar pairs, like the Aussie starting to find a little bit of support down here. The Kiwi actually is up on the day, and we're holding the support as well. So you got to I think you got to be a little careful being long dollars at this moment. But it's not just the boons. You got to take a look at bonds. Look at 10-year. We have that flag pattern, and we're hitting new trend highs. I mean, this is a bull flag pattern. So you can see the bull flag pattern. Whoops, that's not what I wanted to grab. Move that. I didn't mean to move that whole thing here. There we go. Let's make an adjustment here. Snap it back to the highs and lows, so you can kind of see what the extensions might take us to. There we go. Okay. So the bond market, you see that bull flag pattern. I mean, it points us out to the 127% extension, which could take us, above 130 in the 10-year. I mean, that's, the potential there is quite aggressive. If bonds continue to rally like this and yields sell off, the question is what happens to like the dollar yen. And you look at the dollar yen, which is also threatening. We have this bear flag, and we have a bear flag and a bear flag. So, not only do we have, here, let me grab my drawing tool here, but here we go. So you have this, this flag that could play out lower right here. Then you have another flag pattern. I mean, everything that I see in the dollar yen points to 107, at least 107, and maybe even lower towards 106.30. So again, the dollar looks weak, and it looks like it's quite possibly we could go lower. So anyway, that's just a few things that I see going into today. I'm going to reiterate really quick, and then I'm going to talk to you guys about something else. I'm going to reiterate it. You got to be a little careful being too long the dollar at this point ahead of the FOMC. So knowing that we have the Fed tomorrow, the Fed meeting tomorrow, just be a little bit careful being aggressively long the dollar at this moment, because with gold moving higher, silver moving higher, you got yields that have that continue to drop. I think you should be a little careful with the dollar. Okay, now I want to stop and talk about, just take a few minutes to talk about something else. If you guys didn't or don't remember, from a few weeks ago, I have a young man, or had a young man sitting next to me for a few days, who is very interested in currency trading. His brother and my youngest son are on the same baseball team. Anyway, he came to sit with me for a week, and we talked about currencies and about what I do. And he's actually quite talented at reading charts, and he's been trading the currency market for a little less than a year, and really getting to know the markets. Anyway, he is spending another week with me this week. He's sitting in my office right now, because I went on holiday. Him and his family went on a little bit of a break, so he was coming this week to come sit with me for the remainder of this week, just for a couple hours a day. Anyway, we were discussing about indicators, okay, and indicators on our charts, and we were having this discussion about relative strength. And I'm like, well, I've been using relative strength for the last 20 years, and it's not so much what the indicator is telling you, or how the indicator is moving, what you should be buying or what you should be selling. It's just how you couple that with what you currently do, which that's what makes it more how should I say, valuable to you as an individual trader. And then he went on to the question of, well, to be more profitable, do you add more indicators to what you're looking at? And most of you know this answer, but I thought it would be a good talking point, especially for today, is we all trade the markets differently. Everybody uses a different set of indicators, what they're looking at. What I do and what I found is what I use works for me. And it doesn't mean what I do is the end all be all of trading. What you guys do as traders and what you use as traders is what works best for you, what best suits your trading style, your trading strategy. And you're not gonna make more money by increasing the number of indicators or different indicators. That's not how you increase profitability when you're trading. How you increase profitability in trading is finding a strategy that works for you, that you find fairly consistent results. When I say fairly consistent results, because you're not going to find a strategy that works for you all the time. There's just no such thing. But you find a strategy that, whatever technical analysis you're using, whether it's Elliott waves or fibs or harmonic patterns or whatever, if oscillators, whatever it may be, you're using indicators that yield you consistent results 65% of the time, 70% if you're hot, but that most of the time it works for you. Then you increase your size. And then as you increase your size, that's how you increase profitability. You have to find a strategy that works for you. Like, I know what works for me. I know, when I, see this coupled with that, and then, whether I'm looking at a confluence of multiple fibs and then I see a divergent relative strength, or, whatever the case is. And if I apply a trade, if I take a trade, the profitability comes from me moving up my position size based on my confidence that I see in those particular indicators. It's not, adding another indicator that's going to yield you more profitability. What I see traders do over the years is they end up chasing their tail for years and years and years, trying to, slap this indicator on and that indicator on. And then what happens is 4, 5, 6, 10 years go by, and then they come back and say, if I would have just done this, if I would have just stuck to that, I would have been fine. And I see that happen over and over and over again. One of the things that we do here at ForexAnalytix and at the Face webinar is we try to, I try to minimize your learning curve as much as possible. And one of the ways I can possibly do that with what I'm telling you today is, find what works for you and just stick with it, and then work on, risk management and increasing your, and increasing your position sizes versus trying to slap on another indicator, because really it's just finding what works for you and then tailoring a good risk management strategy around your entries. All right. So anyway, I thought it was a good conversation to have today, especially, ahead of the FOMC, where, markets might be a little muted, because I am expecting bigger moves from tomorrow and throughout the end of the week. So with that being said, Steve, I think you're here. Maybe not.
I'm here.
Oh, hey, Coach is here. Hey, Coach, how's it going?
There's Steve.
I'm here as well.
Okay, so do you have any comments to make about what I just mentioned about strategies or indicators or anything else?
No, I'm in total agreement with you. I personally don't see any reason for people to use more than an RSI, because the best indicator is your trained eye to recognize patterns, and an RSI is always useful because it gives you a much easier way to grasp on one look momentum. I find it particularly funny, which I see very frequently, when people use multiple momentum indicators, which are, you use a stochastic and a MACD and an RSI at the same time, which all of them tell you the same thing. So yeah, it's, it's what you said, Blake. I couldn't agree more. Teaching yourself, finding a way that consistently works for you, sticking to it, measuring performance so you know what you've been doing wrong, what you've been doing better to do it better in the future, and don't clutter your chart with indicators, because the vast majority of indicators can be grouped in one or two useful kind of indicators. The rest are just the same thing.
And it doesn't have to be an RSI. I mean, I use an RSI because that's what I learned on. But doesn't mean that you can't use a MACD or whatever indicator fits your bill and suits your style. I happen to use an RSI because that's probably one of the most common. And what you probably notice, if you haven't yet, for those people that have been listening to my webinars for, I started broadcasting about 15 years ago when I was with the Wise Trade Group. And, many listeners that are listening in right now have been listening to me for 5, 10, 12, 15 years. What every one of them can attest to is my charts haven't changed. My charts look exactly the same today than they did 10, 12, 15 years ago. Minus, I might adjust a moving average here and there, but moving averages more, show me momentum versus anything. And I just happen to keep a 50 and a 200-day mostly on my charts, and sometimes I'll flip it over to some EMAs, but all the indicators all the same. Hey, listen, we have housing starts coming up, building permits as well. And so once this data comes out, I'm going to be switching it over to Steve. Stelios is not here, so we'll see that data come out here in just a moment, Steve.
Stelios is swimming just to make us jealous.
Yeah, swimming in the Aegean Sea.
And you miss carrying around your charts in the chart book era, Blake.
All right, stand by. We are there we go, about 10 seconds away.
Chart book.
And I have it on the euro, but this shouldn't be much of a market mover. All right. So, data is mixed.
housing starts is actually quite horrific, huh?
See, Trump is right. We need to go to zero.
Yeah. You know, just I think overall mixed data. We're not going to see much of a movement here. So
especially ahead of the Fed.
Yeah, and especially ahead of the Fed. You're right, and there's not going to be any real reaction here. So I think you're going to see some book position squaring going into today. Just be careful getting too married to any position here. So Steve, I'm going to pass it over to you. You guys have a great one, and I'll see you here tomorrow for FOMC prep.
By the way, Blake,
Okay.
quite an interesting day, yeah?
With today?
Many days you see bonds, gold, everything bid. Everything is bid at the moment.
Oh yeah. It's pretty. It's wild. Something's gonna break, but I'll tell you what. These precious metals look pretty strong right now.
Yeah, they do. Bye bye, Blaker. Talk to you later.
Talk to you guys soon. Bye bye.
Hey, Coach.
Hi, Steve.
How are you?
Good. So the yields are blowing out some RSIs. So I was thinking about
by the way,
taking a shot here.
Boon 10-year sorry, book minus 0%. There's your opportunity.
Yeah. TLT. I was should it get to that level I've been talking about for a week or so on this 133 and a half or so. But this is a good lesson. So you could have targets and be thinking about positions, but it's not just that it gets to a price, Steve. It's how it gets to a price.
Yeah, absolutely.
Okay, so
you remember after
right.
3%, everybody was looking for an explosion higher, and just a few months later, we're threatening to break down below 2%.
Well, not as much that how it gets to a price speaks more towards momentum, velocity, especially if you're looking to come in and look for a reversal, turning point. So to me, when the move is being confirmed, okay, tells me, Dale, you have time to try and bottom pick this or top pick this. It has to either go through an accumulation stage where lower lows are not being confirmed by momentum, because markets rarely bottom when moves are being confirmed by momentum. And I'm an RSI guy too, Steve.
Yeah. Speaking of the
simple implicator.
Yeah, speaking of the 10-year, here we are almost threatening the 2017 September low. And, if we break below this 2013, then we're going to be talking about levels, yields in essence, that we haven't seen since 2016. So quite a big, 180 degrees reversal here, right? Everybody was bullish up there, and we're now pushing the lows. Of course, somebody can claim that the exact opposite is happening now. I mean, everybody's now looking lower. Perhaps we're
there is some divergence on the daily.
Yeah, there is indeed some divergence. I mean, I wouldn't be surprised.
Not on the short-term TFs.
Yeah, I wouldn't be surprised if in the short term we find some kind of a support here and we rebound. I wouldn't be surprised at all, because it's already overdone, this move, both in the US Treasuries and in the bonds. And something in particular that I was looking at yesterday night actually is, let me open a chart of the S&P that I don't have any drawings on it, because it's going to be much easier to see. So let's choose this one, for example. Okay. So let's choose this one, and let's overlay on this the 10-year treasuries. Okay. So now check this out. Clearly, what is regular here in the vast majority of the cases is an inverse correlation, okay, inverse relationship. But lately, as you've seen, I mean, exactly since like a few weeks after we bottomed out, after this move lower that we had following that crazy run higher in the S&P and risk assets in the end, up to the end to 2018, we have seen a relationship between treasuries and the S&P that is mostly a positive one. Okay, so there have been some periods in the past as well. One of them being here, just before we peaked in 2007, right? Check out this period. I mean, from the highs that we had in 2007, from June 2007 to the highs, we had a positive correlation once again between, the S&P and treasuries, and we know how this ended. Of course, this is not an indicator on its own, but it's something that that I am paying attention to, because I don't think this positive, even in the short term, you can see it here. If I zoom in, you can see how positive the correlation has been here, right, between treasuries and and the S&P. That's quite strange, and I don't expect that this can go on for longer. Especially today, that I mentioned before, we have an extra element. We have gold also being beat up at the same time. Also quite strange behavior having to do with intermarket relationships. Okay, speaking of gold, Blake said what was to be said very briefly. I want to show it. Yes, we're pushing again towards this 1360 area, but I would be a little bit careful here, because I also see the possibility of an ascending wedge being in play here. So let's see what's going to happen from here. Definitely a break above 1360, 1365 is going to be a huge bullish development. But, I would be quite cautious ahead of that area. Needless to say, especially ahead of what's happening tomorrow with the Fed. If the Fed, for some reason, comes out, less dovish than the market currently expects, especially considering how important this technical level is, you can end up seeing like a huge reversal here in gold. Now, silver, obviously not quite obvious, as gold. Okay, so obviously, if you want to be short one of the two, that would be gold, given the fact that it's very close to key resistance. Of course, important resistance is also this 38.2 for silver, but it's absolutely not the same as what we've been seeing with gold. Another pair before we go to the majors that I was closely monitoring, especially today, since earlier today actually, is the euro pound, because the euro pound has actually entered now an area of resistance that is quite important. You can see here today, we even bridged through intraday from the 78.6. As you see from my drawings, I expected a reaction from there since many days ago. We did have an initial reaction lower. Now we're more or less unchanged on the day. So what we have in place now is a spinning top, which is an indecision candle. Of course, it's very, very early on the day to to give it any significance. But even if we assume that we're going to break above the 78.6, I would still expect that the euro pound would have a major hurdle ahead, because we also have this large descending channel. You can see it here. Its resistance currently passing from 90 cents. So another 50 pips to the upside, depends on what kind of trading you do, is not anything big. So, that is why I'm actually going to start selling the euro pound here. For details, I'm going to write it in the chat room once this webinar is done. Looking for at least a temporary reaction lower. So I do think that the euro pound is interesting and does provide and produce quite a nice opportunity here. Of course, depends on what kind of trader you are, as I said, but this is my point of view. Now, having to do with Euro USD, not much to say there. Blake covered it. Having to do with the pound, though, Blake didn't happen to speak about the pound today. I have to tell you that the fact that we've broken to new lows is obviously another significant sign that we have a bearish continuation happening here. I know that it's very oversold. It's not that I would advocate for somebody to be selling it here. You could be selling it, higher once we broke below this triangle. But even when that happened, it wouldn't be easy to get in a decision like that because we had this descending wedge. So even an initial pullback could be viewed as an opportunity to buy for another leg higher. I was also thinking that was a possible scenario, as it seems it isn't. That's one of the good aspects of being quite careful and not jumping the gun. If you remember, I was quite actively looking to be short dollar against, a basket of currencies, assuming that the dollar would, keep on moving lower because we had the first sign that we were breaking lower, and that happened when we actually broke below this purple ascending trend line. You can see it here. But then we never got the second thing happening, which was penetrating through these ascending channels support and the 200 EMA. As you see, the confluence of those two, the 200 daily moving average and this ascending channels support, is what actually stopped the move lower from the pair, and we've had this rebound since. Now, does this make me outright bullish from here? No, I don't think so, especially now we're testing again this resistance area at 97.70. So I would definitely be buying dollars here on this resistance, and especially ahead of the Fed. So I do think that we're currently in a consolidation of some kind, and unless or until we break either above 98.30 or below this previous low at 96.60, I would rather stay away from making like long-term, medium to long-term bets about the fate of the dollar. I am a long-term bear having to do with the fate of the dollar. I do think that the dollar next big move is going to be to the downside, but that in no case means that it can't move higher first, right? So, my long-term thesis doesn't affect in any way my medium-term thesis because, simply it can end up losing the money. So I'm waiting for a technical event here, which for the time being we don't have. As long as we don't have it, of course, if you have to favor one side, it has to be the upside, right? Because the dollar has been and has remained very, very well bid, as we've shown many times since February 2018. So we are approaching 1.5 years that the dollar has been in an uptrend. Momentum has definitely waned, but from having a waning momentum to calling a reversal, there is a big distance between the two of them. Now, having to do with the S&P, we're obviously pushing higher from this consolidation. Now, do I think that we're headed directly from here to new highs? The short-term structure doesn't tell me something like that. I would probably expect from here or from a little bit higher some type of pullback before perhaps seeing more strength. So I wouldn't be buying the S&P here. Okay, as simple as that. I don't think we're going to be pushing new highs before some type of a pullback, because what we had recently can't even be characterized as a pullback. You can mostly call it a consolidation. Okay, it was a horizontal consolidation. I shorted that because on the 4-hour chart we had an ascending wedge. I got really lucky because my target got triggered intraday before we got a big reversal. I also had a pattern in play for that, so people that are subscribers know it. Some of them definitely followed it, but yeah, it doesn't even qualify in my mind as a corrective move, just as a horizontal consolidation. Levels of interest, one of them we're testing now, 29.10, and above that 29.30 is the next one. Then it's all-time highs after that. Definitely though, the move that we had lower, the larger move that we had lower from May, from the beginning of May to the beginning of June, this 1 month move lower has definitely corrective characteristics. So in general, I would still favor the upside. Okay, just not in the short-term buying here. I don't think it makes any sense. I think a pullback would probably provide good buying opportunities. Just close your eyes and buy. You know how that is. I mean, it doesn't make sense from a fundamental perspective, but it is what it is. The DAX, unsurprisingly, we're moving higher here. The DAX clearly an ABC move lower here as well. We ended up consolidating for a few days around the horizontal support resistance area, and now we're moving higher again. Obviously, Draghi's comments today and the fact that those comments also produced a pullback for the euro, both of those are assisting the upside. That's why at some point we were lower on the day in the DAX, and now we're much, much higher, in essence, leaving behind an outside white candle. Most likely that's how I expect the day to end. I don't expect for the index to go back to negative for today. So I do think that's going to be quite a good day for the DAX, posting quite a bullish candle, as I said, and signaling that, we have more upside coming with the next area of resistance, obviously being this previous high at 12,450 roughly. That's where it is. Let me go ahead and have a look at a few of your questions. Close this. Open the chat. Let's see. One-way market whole year. USD Swiss and JPY strong. Dirty market. USD NOK, please. Yeah, not a bad idea. Let's have a look at what's happening with USD CAD, USD NOK, and crude, by the way. So USD CAD showing quite bullish. I thankfully closed, as I said that day on the webinar, I closed my attempt to be short. I had said on the webinar that I'm probably going to close it because I didn't see any follow through and I didn't like that. So I got rid of it because I would have been hurt. Sometimes you need to keep an eye open for what's happening if you get what you're expecting from a resistance area, and that's not what happened. And I have to admit that despite wanting to see lower levels, not a lot lower, I was looking for 131.20 because we had a nice confluence of supports down there. So I wanted to see that support tested, but you're not always getting what you want. So USD CAD is showing quite a nice rebound, currently testing a horizontal resistance area once again, but I wouldn't be trying to fade it here because there is quite a decent chance that we're going to keep moving higher this time, actually testing the resistance I was looking for initially, which was that 136.60 area. So why not? We might have a move towards 136.60.